Good evening, ladies and gentlemen, and this is Barry Norman on behalf of CMS Trader and Investing.com, and welcome to our quick little webinar on CFD trading, the wave of the future. Now, tonight's class is sponsored by CMS Trader, one of the world's leading platform providers for Forex and commodities and spread bets, for Forex, CFDs, and spread bets. Now, because CMS Trader is a regulated provider, I'm required to give you a risk warning, so let me read that and get it out of the way. Trading Forex, CFDs, and spread bets on margin carries a high level of risk and may not be suitable for all investors. You may lose more than your initial deposit and could be required to deposit additional funds. Please ensure you fully understand the risks and take care to manage your exposure. Now, CMS Trader is one of the world's leading platform providers. They have a very unique platform, easy to use with social trading, signals, one-click trading, everything you could possibly want on an internet-based trading platform. Now, you can set up a demo account real quickly by going to www.cmstrader.com and just click on the buy or the sell button. It'll ask you to pick input your email address and pick a user password so that you you can track your trades. And you'll have a demo account open up right away for you so you can take a romp around their platform and see how comfortable it is to use. Now, when you trade with CMS Traders, they offer a very broad range of education. Whether you're a novice, a beginner, a professional, or an experienced trader, you'll find all the education materials you possibly need. They also have no dealer intervention on trades. There's no conflict of interest between you and your broker. And they offer one-on-one training for new clients. You also have many different types of trading accounts. You have unlimited access to their platforms. You get free daily signals, up-to-the-minute technical updates and technical analysis, and all the support you need and extremely fast execution. You can trade from a wide range of instruments, including Forex, CFDs for stocks, commodities, indices, and cryptocurrencies. You can use their watch, copy, and profit social trading, where you can watch some of the most experienced traders and just click on to copy their trade, and you can make it as fast as they do and just copy along at whatever you want to do. You can also learn how to become an independent trader with CMS Trader. They offer a large variety of tutorials for beginners and professionals, plus one-on-one sessions with financial experts, and a very large library of ebooks. Now, tonight's class is being recorded, so if you'd like to see a copy of this class, just go to investing.com and about 24 hours go to the webinar tab where you signed up for the original webinar and look under there for webinars on demand, and you'll see all of our recorded webinars there. So let's get started talking about CFDs. Now, CFD stands for Contract for Difference. Now, CFD trading is ideal for investors who want the opportunity to try and make a better return for their money. However, it contains significant risk to your money and is not suitable for everyone. We strongly suggest trading on a demo account before you try trading with your own money. Now, is CFD trading right for you? CFD trading may be ideal for people who are looking for short-term opportunities. CFDs are typically held open for a very few days or weeks rather than over a longer term for those who want to make their own decisions on what to invest. CMS Trader provides an execution-only service. We do not advise on your trades or trade on your behalf. If you're looking to diversify your portfolio, CMS Trader offers over 4,500 global markets to trade on, including shares, commodities, Forex, and indices. You could be an active or a passive trader, whichever you want to whatever degree, and you can trade with as little or as often as you please. Now, contracts for difference are one of the world's fastest growing trading instruments. A contract for difference creates, as its name suggests, a contract between two parties speculating on the movement of an asset. The term CFD, which stands for Contract for Difference, consists of an agreement or a contract to exchange the difference in value of a particular currency, commodity, share, or indice between the time at which a contract is open and the time in which the contract is closed. So in other words, you don't own anything. You don't own the underlying asset. Now, the contract is simply a contract between you and your broker and the exchange or the market maker for that CFD. And what you've got is a contract that will pay you the difference between where your open position and where your closed position. So if you open a contract and you buy the contract, that means you're buying the underlying, you're not taking physical delivery and you're not buying, but you're saying you think the asset is going to move up. When you close your contract, if it is moved in the direction you selected, you get the difference between the open and the close. If it's moved against you in the opposite direction, you have to, you suffer a loss equal to the same as you would have made the profit. And the unique thing about CFDs is you can also sell or go short, trading a market to go down. So in other words, if you think that Bitcoin is going to fall, you could open a position or sell Bitcoin at this point and say it's trading at $16,000. You can sell it at $16,000, and when you want to close your trade, you always have to do the opposite position. You always have to consist of a buy and a sell. So if you sold first, you have to buy back. So if you can buy that Bitcoin at 15,000, you get the difference because you traded in your favor. But if you have to buy that Bitcoin at 16,500 to cover your position, you would have lost $500. So you can go long or short in either direction, except to fulfill a CFD contract, there must be a buy and a sell. Doesn't matter which one takes place first. But if you sell the goods, you have to eventually buy them to offset your contract. If you buy the goods first, then you eventually sell them. The contract payout will amount to the difference in the price of the asset between the time the contract is open and the time it is closed. If the asset rises in price, the buyer receives cash from the seller, and vice versa. There is no restriction on entry or exit price of the CFD. No time limit is placed on when this exchange happens, and no restriction is placed on buying first or selling first. CFDs are traded on leverage to give traders more trading power, flexibility, and opportunities. So put simply, CFD trading lets you speculate on the price movement of the whole host of financial markets, such as indices, shares, currencies, commodities, and bonds, regardless of whether the price is rising or falling. This means you don't actually own the underlying asset. You're simply speculating on whether the price will rise or fall. Now, a commodities future is a financial asset that represents an agreement to buy or sell a set amount of a commodity like platinum, copper, or gold at a predetermined price at a predetermined date. Because the price of commodities fluctuate over time based on supply and demand, a commodity future allows traders to speculate on the price movement of that commodity. If you trade the platinum CFD, you can decide whether you think platinum futures will rise or will they would fall, and then place your trade accordingly. Other commodities include copper and oil, Brent oil or sea oil, coffee, wheat, and corn. The thing is, in a futures market, you would have to buy 50,000 bushels of corn or 1,000 barrels of oil per contract. In CFDs, you're not buying the underlying asset, so you can buy whatever or sell whatever amount you want. If you want to only buy 10 barrels of oil, that's perfectly fine, because the difference is in the futures market, you have to have a specific contracted amount, and it also expires at a specific date, which the CFD market doesn't happen. So whether you trade an index CFD or a commodity CFD, from where you will place your trades on the same platform where you execute Forex trades. It's easy to move between Forex market and the different CFD markets and quickly enter and exit trades with precision, accuracy, and speed. All Forex trades are CFDs since they are not buying the actual currency. You also have the option to do the same with cryptocurrencies and most major stocks. So let's take a stock investing as an example. Let's say you want, and you need to remember this example because we're going to use it several times in tonight's session. Okay. So now if you wanted to buy stock, so let's say you wanted to purchase 10,000 shares of Barclays, and Barclays was trading at 280p, which means your total investment would have been 28,000 pounds, right? So if you call your stockbroker on the phone and say, I'd like to buy Barclays, he gives you the price, you come, you tell him you want 10,000 shares, you can send him a check for 28,000 pounds, not including commissions or other fees he would charge. But in exchange for this, you receive a stock certificate, legal documentation that certifies ownership of shares. In other words, you have something physical to hold in your hands until you decide to sell them, preferably for a profit. That's if you're actually buying it. But with CFDs, however, you don't own those shares of Barclays. You're simply speculating and potentially profiting from the same movement in the share price. So remember this. 10,000 shares, 280p, 28,000 pound cash investment. Now, there's many reasons you might want to trade CFDs over actually owning a stock. Number one, they're much more tax efficient. They're more flexible, and you could have sold those shares of Barclays because you thought Barclays was going to fall. You can't do that when you're actually buying a stock. You can only do that in the CFD market. You also get leverage. It means you use a small amount of money to control a much larger tool. And also, you can hedge. It's a great way to hedge. If you had bought Barclays and you had shares and you thought they were going to go up, you could actually take a CFD to offset your potential loss of your other investments. When you open a CFD position, you must select the amount of the CFD you would like to trade, and your profit will rise in line with each point the market moves in your favor. So basically, if you bought a traditional share or you bought a CFD, the process is almost the same, except you're buying at the price or selling at the price. You're doing it through your broker, and you suffer the same consequence. If the shares move up, you make the same amount of profit, and if the shares move down, you have the same amount of loss. The difference is the capital required, because you're saying, well, I needed to buy 10,000 shares of Barclays because I only think it's going to go up a couple pips, but if it goes up those couple pips, if I had 10,000 shares, it's a nice profit, but I don't have $28,000 to lay out. Okay. So if you think the price of your chosen market will go up, you click buy, and if you think the profits will rise in line with any price increase. However, if the price falls, then you will make a loss for every point it moves against you. So remember, when you buy the shares, if they move up, you get the profit. If they go down, you get the loss. If you sold the shares ahead of time, you would then get the profit if it fell down, or the profit gets lost. Now, CFDs do not have an expiry date like options or future contracts. Opposed to an expiry date, a CFD is effectively renewed at the close of each trading day and rolled forward, but there's nothing you have to do about it. Now, again, one of the biggest advantages, you can go long or go short. So you can make profit in a falling market as well as profit in a rising market. And with CFD trading, you select the number of CFDs you wish to trade. You can pick one, or you can pick 10,000. It's not, like I said, there is no lot size, there's no minimums, there's no contract size. CFD trading is a leveraged product, which means you only need to have a small percentage of your overall trade value, known as margin. If your account, in order to open your trade, in your Generally speaking, the larger the value of your trade, the more margin is required. But you can get leverage up to 200 to 1. That means if you have $1,000 in your account, you can actually control $200,000 worth of the market. CFDs are a leveraged product, which means that you only need to deposit a small percentage of the full value of the trade in order to open the position. This is called trading on margin. While trading on margin allows you to magnify your returns, you also magnify your losses. But you can open up a lot larger position for a smaller amount of cash because your margin is a very small percentage of the value of the position. This means you gain a much larger market exposure for a relatively small deposit. In other words, your return on your investment is significantly larger. So let's go back to the Barclays example. Remember, I told you to remember this. Those 10,000 shares of Barclays were at 280 pips, costing you 28,000 pounds. Now, with CFD trading, however, you only need a small percentage of your total trade value to open that position and maintain that level. So let's suppose that we give you 10 to 1 leverage on Barclays shares. That's a small amount of leverage. But in that case, you would have only needed to have 2,800 pounds in your account to trade 28,000 pounds of Barclays share, or the 10,000 shares. Now, margin is not a cost to you. It's simply a deposit. That's all it is. If your asset goes in your favor, your profit's put in your account and your 2,800 pounds is released. If it goes against you, the loss is deducted from your account and the 2,800 pounds is released back into your account. So if Barclays shares rise 10%, just 10% to 308 pips, 308 pence, the value of the position is now 30,800 because you had 10,000 shares. Whether you bought them on leverage from CFD or you bought them from your stockbroker, the value now is 30,800 pounds. So with your initial deposit of just 28,000 pounds for the CFD, 2,800 pounds for the CFD, your profit was also 2,800 pounds. So you made 100% return on your investment because you put up 2,800 pounds and you made 2,800 pounds of profit. And when you close your position, that 2,800 pound margin was also released back into your account. So leverage offered by brokers allows you to open positions larger than what the actual capital allows. Many brokers offer up to 200 to 1 leverage on various CFD instruments. So for instance, to get a better understanding of it, if you wish to trade crude oil and you only want 20 barrels and it's trading at $44 a barrel, your trade value would be what? $880. Now, if you want to trade in the futures market, you could only buy 1 contract of crude oil, which would have been 1,000 barrels. So that your minimum investment in the futures market would have been $44,000. But here, you can only buy 20 barrels. You can buy 40 barrels. You can buy 52, or you could buy the 1,000. Now, however, due to the 100 to 1 leverage offered you on crude oil, you only need 1% of your position size in order to hold this position. You need to put up $8.80 to secure that 20-barrel CFD. Now, if crude oil was up $1 a barrel, you made $20 on your $8.80 investment. Leverage trading can magnify traders' profits, however, at the same time, you should take into account that losses will be magnified as well. But there are ways that you can minimize your losses and protect yourself because you should always deal with risk. The important thing is to remember about leverage, however, is that while it can magnify your profits, your losses are also magnified the same way. So if price moves against you, you may be closed out of your position by a margin call or have to top up your funds. So it's important to understand how to manage your risk. So let's go back to our Barclays shares. If Barclays shares decline 10% to 252p, the value of your positions now is only 25,200 pounds. So an initial deposit of 2,800 pounds, the CFD trade, you had made a loss of 2,800 pounds or had a 100% loss on your return, compared to 10% return on the shares you would have bought physically. So it magnifies your losses. But when you trade CFDs, you can place what's called a stop loss. A stop loss you can place when you're opening your trade, and a stop loss will automatically close your position when the market moves against you at the price you pre-designate. And we'll talk about this a little bit more. But let's talk about first your cost of trading CFDs. And CFDs are traded on what's called a spread. There's no commissions and no fees on CFD trading. The broker makes his profit and covers the expenses by the spread. That's the difference between the buy price and the sell price. So most of the CFD instruments are traded on what's called floating spreads. Different assets have different spreads based on market volatility, and the more unique or the more exotic the asset, the higher the spread is. They're always posted, but whenever you're trading the majors, and they're all competitive, but whenever you're trading the major assets, they all stay pretty well fixed at very small amounts. So you're trading the euro, you're trading Bitcoin, you're trading oil, you're trading the euro, you're trading the pound. They're all pretty well set, and they are actually very, very small. And the best way I can explain it to you, so you understand the spread, is if you go to the bank because you're going on vacation, say you're leaving London, you're going to Germany on vacation, you need euros. So you go to the bank and you tell the bank, I need to buy euros. Well, they say, okay, we'll sell you euros because the bank's selling you euros, you're buying euros at so many pounds. Now, there is a price in which they'll sell you euros, and there's a price in which they will buy the euros from you to give you back. So when you come back from holiday and you need to convert back the extra euros into pounds, it's not the same price that you sold them for, that you bought them for. It's a different price. It's the difference between what they're buying from you today or anytime and what they're selling you today. In the old days, when you traded money, when you went to the bank and moved money, or went to an exchange on vacation, they called it a commission. But the commission is long gone, and now it's the spread. It's the difference between there's the market value, which is the center, and the price that they're willing to buy it or the price they're willing to sell it. Okay, so that's what I say. This is the price the broker's offering you to sell and the price the broker's offering you to buy. Okay. But they're published. They're covered by regulation. They are strictly out there, even when the markets get volatile. Like when we're going into the Brexit vote, all the brokers raise the spread. They're raising their spread because the markets get volatile, and they don't want you to get stopped out or lose all your money because it's only a deposit. So CMS offers very attractive trading fees, charging only the spread on the open positions. Spread is the difference between the sell and the buy. When calculating a cost of position, you need to multiply the spread by the size or the amount of the CFDs you're buying. But the spread is very, very easy, and it's always published on the site. You see the buy price and the sell price. And between it is what's called the market price. And you'll also see the market price. Now, there's also many types of orders that you can place when you're placing a CFD. Unfortunately, too many people don't learn how to trade, and they just enter a buy or a sell. And that's called a market order. And the system will just generate your CFD purchase or your CFD sale at the price of the market at present as quoted on the site. But a smart trader knows how to take better advantage of placing orders. And you can place what's called a limit order. In other words, if those shares of Barclays were trading at 280p and they've been bouncing around all day between 280, 279, 278 to 300, you say, I don't want to buy it at the current market price. I only want to buy it if it falls down to 275. So you can put in what's called a limit order and instruct the computer only buy it when it dips down to 270. The price doesn't stay exactly where it is, and it bounces all around. So that the minute it dips down to that 275, the system will make your buy. Or if you think Bitcoin is trading too high and you think Bitcoin's going to fall, but you want to make sure it falls. So it's trading at 16.5. So you can tell the computer, buy it for me, or sell a position for me, or sell a CFD for me whenever Bitcoin hits 16.7. So when it bounces up for that 1 second, it hits 16.7, the computer will sell as you instructed. Then the stop loss is what you put on the other side. A stop loss is where you protect your losses. And you tell the computer, if this asset that I'm going to trade falls below this price, automatically close me out at this price level because I can't afford or don't want to risk any more money than this. So you can learn these. They're not very complicated, but there's many easy ways to protect yourself and trade smartly that has very little to do with really understanding the financial markets. You don't have to worry what Donald Trump's going to do, what North Korea is going to do, what the Federal Reserve is going to do. First, you need to know you can make profitable trades just using the proper order, entry, and risk return. So it's all about simply understanding some basics. And then lastly, of course, monitoring your trade. There's many things you can do on a trading platform, but you can constantly change your stop loss. You can also set a take profit point. So in other words, if Bitcoin is it's trading at 16,000, and you buy, or let's say Barclays share, you bought at 280 pip, right? Now, in our example, you closed it out at 302. Well, you could have told the system when you open your position, if Barclays ever hits 310, close my position, take my profit. And even if it perks up there for 1 second, the system will close out your trade at the level you told it and take that profit for you. But you can monitor your trades and continually move all these. So like what I do is when I put a stop loss, I put it fairly close because I don't want to risk any money. And as the asset moves in my favor, I keep moving my stop loss closer up. So if I bought Bitcoin at 16,000, put my stop loss at 15,950, if Bitcoin goes up to 16,200, I move my stop loss up to 16,000. It means if the market even turns against me at that point, I at least break even. But then what I do is I go sell half of my position at the 16,200, and that means if the market moves against me, what happens? I close out my position at break even, and I made the profit on the half. If the market then moves up to 16,005, I sell another half and move my stop loss up farther. These are easy mechanical type strategies that you can learn so you can monitor your stops. Because having placed any stop loss or limits, your profit and loss of your CFD trade will now fluctuate with each move of the market. You can track market prices, see your stop loss and profit and loss in real time, and add new trades or close existing trades from your computer or by using your tablet or your smartphone at any time. So it's very easy to also manually close your trade. Once you're ready to close your trade, you just need to do the opposite trade to opening the position. Now, if you set stop losses, take profit points, the system does all that for you. But you can always just go in and close your position. And then your profit will be immediately placed to your account. But if you got a stop loss in there or a limit order and they've been triggered, you don't have to worry about any of this. Okay? And you can also use CFDs to hedge. A CFD allows you to sell short and therefore make potential profit on falling markets. Hedging, should Barclays price fall by 5% in the underlying market, the loss in the value of your share portfolio would be offset by a gain in your short sell CFD. In this way, you can protect yourself without going through the expense and inconvenience of liquidating your stock holdings. For one key reason why many traders use CFDs is as a method of hedging against open positions. If you want an asset in your portfolio that you believe may lose some of its value, CFDs will offset that because you open a CFD in the opposite way because say you own 1,000 shares of Apple and actually physically own them in your portfolio, but you think Apple's going to dip today for some reason, something's going to happen with Steve, but you don't want to sell those stocks. You want to hold on to those stocks, okay? And you don't want to pay the commission and everything else. You can open a CFD in the opposite direction. So in other words, that you think the market's going to fall, and take the profit of the falling market and it offsets the loss in your portfolio. Okay. But there's more to CFD trading than the CFDs themselves. Okay. But there are many ways that you can use CFDs in your overall trading strategies. It's up to you to decide how you want them to work. But if you're ready, go to CMS Trader, www.cmstrader.com. Now, if it won't open in your home position, it's not because there's anything wrong. That means they're not regulated in your home country, and they only trade where they are regulated and have licenses to trade. So go to www.cmstrader.com and open up a demo account and try and see how easy it is to do all of these things we talk about, or try to see how you would hedge against your portfolio if the market. So if the markets move against you in your portfolio, you could offset that downside with a CFD trade. So let's get started trading. Go buy, go trade, go sell, and try it on the demo platform. It's fast, it's free. Just open a demo account, and in no time at all, you'll be experiencing the CFD market. But that's the basic fundamentals, and this is one of the reasons that CFD trading is growing so fast, because it is fully regulated. That means all of your funds are safe, and all the trades are transparent. They're all monitored by the FCA, the European regulators, and CMS is approved by all of them. So you know your funds are segregated. You've got the regulator and the government's watching closely. They've approved the type of trading. Everything is transparent. And with CMS Trader, you get a very broad range of assets you can trade, as well as a very good in-depth education department to make sure you know what you're doing in the marketplace. So thank you very much for joining us this evening. And once again, thank you for giving CMS Trader a try. And you can go to investing.com to see a recorded version of this webinar in about 24 hours. Have a great weekend. Thank you for being part of the investing.com family. And thank you for supporting CMS Trader. Have a good night now.